Well, it's been another underwhelming week with Australian shares dragging their heels. Hi there everyone, welcome to the Traders Circle weekly market update. Today is Tuesday, the 5th of December, it's the 5th already, God, 2023, and before I get into it, you do need to be aware that whatever I say is general advice only. It does not consider your personal financial circumstances, and you have to decide if what I'm saying is appropriate for you. So today was RBA Day, the first Tuesday of the month, and the last RBA meeting until February next year. The RBA, pretty much as expected, left interest rates on hold at this meeting, kept the official cash rate at 4.35%. Now, about a fortnight ago, some people were saying, oh, maybe there will be another rate rise here, maybe there won't be. However, over that past fortnight, we have seen Australian data become a bit less inflationary. We saw the monthly CPI indicator come in lower than expected. We saw retail sales come in lower than expected. And overall, after those bits of data, it became less and less likely that the RBA was going to lift rates. Now, the RBA actually in their statement, though, became probably more dovish than I was expecting. After reading their statement from last meeting, I thought that was quite hawkish. In this statement, they actually did include quite a few things that were, I guess, concessions to, the parts of the market that have been saying, this might be the peak. The parts of the market that have been saying that, maybe they've done enough. And that included things like, an acknowledgement that CPI was coming down. It included things like an acknowledgement that there are plenty of people struggling out there under the weight of higher interest rates. They, did also talk about some people doing quite well out of the higher interest payments and things like that. But overall, I thought it was more dovish than the previous month's hawkish statement. They even changed some of the language around the likelihood of rate rises moving forwards, saying that, it was, again, whether or not another rate rise is necessary, as opposed to, a rate rise might be necessary if. So I thought it was a little more dovish than previous. That did push our market up slightly initially, but eventually we sort of drifted back off a little bit. We gave back most of those gains that we had after the RBA statement. I think we were roughly, 7,050 beforehand. We got up afterwards to about 70, and then we came back off to finish around 70.60. So we did give up some of the post-RBA gains, but not all. And I think that's an acknowledgement by the market that they were perhaps a little more dovish than expected. Overall, though, looking at the RBA and indeed looking at, perhaps some of the talking heads forecasters, historically they've been very bad at predicting forward monetary policy decisions. And, if you want to get a little bit of a forward monetary policy indication of what Australia might do, in recent times it's been look at overseas markets. Basically our inflation has largely followed what has been happening in the Western world, maybe with a slight delay, and our monetary policy has largely been following what's happening in the Western world, maybe with a slight delay. And I think the reality is that if the US pauses and eventually, cuts perhaps around the middle of next year, it's very unlikely that we're going to keep going with the pace of rate rises. And so, given that's become the consensus view, I think it becomes less and less likely that the RBA has another rate rise in February next year. But I guess only time will tell, and there'll be plenty of data between now and then that could change that view. What I do want to talk about as well is our underperformance, how much the Australian market has underperformed equivalent Western nations. You look at the US markets, they've had a ridiculously positive November. We've seen the Japanese market hit 30-year highs. We've seen the German market go back to its highs, and plenty of equivalent Western nations have enjoyed really quite strong periods over the past month. Our market hasn't. We've rebounded a little bit, but we haven't rebounded anywhere near as much. Now, you look at more specific Australian indicators, well, iron ore's at yearly highs. Banking profitability is extremely high. Local economic data, even though it's weakening, that suggests a reduction in inflation, and the overall level of economic data is still really strong. So I think our underperformance really is a bit hard to ascribe a reasoning to, and it perhaps is the fact that our investors are a little bit more worried about further rate rises than those elsewhere. Investors in the US are convinced they're at a peak. Investors in Europe are convinced they're at a peak. Our market is still a little bit uncertain about that. So I think that's the first factor. I think the second factor is Australian markets are Australian investors, I should say, are historically extremely skittish, extremely nervous. We need a universal alignment of divinity before some of the Australian investors will hit buy. As a result, we tend to enjoy some of the gains a bit later on than some of the overseas markets. Even coming out of the COVID period, we had that initial bounce and then we drifted sideways for a month or so while all the other markets around the world enjoyed really strong strength. And I'm just questioning if that's what we might be seeing at the moment. Admittedly, it's going to be hard for us to keep going if the US markets do stall out here. And after a ridiculous November, you would expect them to see some profit taking soon. But overall, I do think that we've been way, way too negative given what's happened around the world, given that our own data is becoming less inflationary, given that the likelihood of another rate rise is going down. I think we've been way, way too negative about that. And I do want to touch on this chart, which is the dollar value of Australian short sold stock. And it's basically at a yearly high. Now, admittedly, this data is a week old. It's only published for up to a week ago. But the dollar value of short positions on our market is sitting at yearly highs. And I think it's sitting at yearly highs at precisely the wrong time. Precisely the time when, for me, the fundamental situation is about as positive as it's been all year. Now, for every dollar that's been shorted on our market, that is a stock, or for every share that's been shorted on our market, that is a stock that's going to have to be purchased back. Whenever you short sell a stock, you have to buy it back later. And so while there is a ridiculous amount of short sold stock out there, that's also a ridiculous amount of shares of additional buying that'll have to be bought back on our market. And if I was one of these people in a short sold position, I'd be a little worried about a squeeze as we move into the end of the year, a traditionally bullish time of year. Food for thought, but when this number being so high, this dollar value of short being high, I see as a bit of a bullish indicator. Finally, I wanted to touch on the Weird of the Week. And this week, it's a little bit of a follow-up to last week's Weird of the Week. We talked about the upcoming Magnus Energy AGM. We talked about the AVO order taken out against a shareholder. We talked about, some of the issues that have plagued Magnus in the past. Well, over the past week, the Magnus AGM happened. And I'm disappointed to report that the shareholder who had the AVO taken out on him, he said he was probably going to come anyway. He did not attend the AGM, and possibly for the best, because apparently there were some belligerent supporters of Magnus Energy at the AGM. So here are a few statements that have been reported by the Australian newspaper as being spoken to their reporter there. I'm not going to read them out. You can read them on your screen now. Some of them are quite colourful. But yeah, these are Magnus supporters basically having a go at one of the journalists in attendance. So apparently the journalist was physically thrown out of the AGM. Again, this is alleged and has been reported by the Australian. And he copped a bunch of flack from shareholders. So possibly for the best that the shareholder who had the AVO taken out on him, who was very critical of the board, didn't attend that meeting. It seems like a fairly colourful company. I think they need a lot to go right for them over the next few months. And otherwise, we might not get any more colourful updates from them. So I will move on to the charts this week, guys, and we'll start with the Australian market. And as we can see, we have had a bit of a rebound in November, but it's a bit lackluster. And to be honest, I'm a bit disappointed with the strength of that rebound, given, what's happened in other Western nations. We have seen, however, higher peaks and troughs through this period. It's just that all the gains have been happening on 1 or 2 days, and then we've drifted back off. And that could be the case with Monday's gain, and then us drifting back off a bit today. So I think we're probably still more range bound. At the moment, to the upside, I think the 200-day moving average is holding us back. And to the downside, I'd be looking at somewhere around 69.80, 7,000 as the downside, the bottom, the lower band of our current move. Overall, looking for a higher trough and then another higher peak on a potential move higher into the end of the year. For the US market, they pretty much did what we were expecting. They reached that yearly high of 4,600, and if you have a look at their move throughout the month of November, it is pretty ridiculous. Right at the end of October, they're around 4,100. and they just reached 4,600 on the S&P 500. That's a 12% move in the space of roughly a month. Very unsustainable. Anyone who's bought stock on the S&P 500 this year is likely in profit, and eventually it becomes harder and harder to keep rising. People who are in profit start to take them, and we do get a bit of a pullback. On a pullback, we would expect a higher trough, perhaps somewhere around 44.50, something like that, before the market continues to go again. If it does, manage to inexplicably keep going and break above that 4,600, we'd expect to see another leg higher. But it definitely looks like that momentum is starting to slow, and the market is just starting to drift sideways up at these yearly highs. So that's it for this week, guys. Unfortunately, our market continuing to drag its heels. I do think there needs to be a bit of selling wash through this market. Eventually, some of those shorts may need to be covered, which might help us push up into the end of the year. I think our market's being supported by a slightly more dovish than previous RBA, by the data becoming a bit more, a bit less inflationary than it has been, and by continued strength in things like iron ore prices. So I will wrap it up there for this week. Hopefully you guys enjoyed. If you did, give us some love. If you didn't, keep it to yourself, and we'll see you in the next one.